China's economy is gaining at a faster than expected pace. The country reported its first quarter GDP rose by 4.5% year over year, marking the strongest three-month growth span since last year. China's economy is seeing benefits since lifting strict COVID restrictions and easing crackdowns on some of these large tech firms. Retail sales climbed by 10.6% in March, significantly beating expectations. So how should investors play this data? Well, let's bring in China Beige Book CEO Leland Miller. Leland, I first want to get your takeaways from this data, given the expectations going into it, and what you're really taking from this.
Well, it's a very interesting time to be talking about the economy because, for weeks we have been suggesting that markets have been too glum on China, that Q2 was going to be a much more significant cyclical bounce back than people expected. Our March data was better than our February data. So we see an economy reactivating. On the other hand, you look at the Q1 print, 4.5%. That's nonsense. They pull growth forward from the second quarter in order to make the first quarter look better. So people are getting energized a little bit earlier than they otherwise would. But I think the second quarter is going to look good. I think that you are entering a cyclical bounce back in China. So people are right to be excited. They're not, they probably shouldn't be taking much stock in the first quarter numbers, though.
What does this mean for some of the economies that also can benefit? I mean, the IMF, they were talking about, even within their projections earlier this year, the beneficiaries of when China's growth rate rises by 1 percentage point, growth in other countries and what that leads to as well. So where do you expect this to also flow into other regions or even companies that are trying to operate in China?
Well, that entire idea is mostly wrong. Higher China GDP growth doesn't create growth in other countries. Trade creates growth in other countries. So if you see Chinese demand domestically jump, if you see the import numbers jump, then you can see where the recovery in the Chinese economy can really help neighbors and the rest of the world. The problem here has been that the import numbers have been very, very low for a very, very long time. It's been mostly an export story. So look, if this is turning around, if you do see strength from the Chinese consumer finally, then yes, that could be a benefit to the rest of the world. But the idea that Chinese GDP is going up and therefore the world is going to get better, that's a flawed conception.
Well, certainly one that the IMF has. That has been that narrative that they've sort of been toting, that China's growth is going to be what ends up lifting all the boats here. But I also want to talk to you about some of these multinationals who have exposure to China. Perhaps people who are saying, is this a good time to get in there? You're saying perhaps by the second quarter, perhaps the GDP and retail numbers might be closer to fact.
Well, yeah, look, the second quarter numbers are all shaping up to be much, much better. You could see that in our data, just as the improvement as we got into a pretty weak Jan-Feb. March was much better. We expect April and May and June to be much better than that. But again, the big question here is what's happening in retail. You look at this number for retail sales in March, it got everyone excited. We're not seeing that level of strength. We're seeing improvement. We're seeing conditions improve in investment and hiring, et cetera. But, the economy is not quite there yet. So if you do see consumer spending jump, even for 3 months, people are going to get very excited. The question is, can they have numbers that stay elevated for longer than 2, 3, 4 months? Structurally, that's going to be very difficult because of the impairments on the consumer in China. So we're going to see whether this is a 1 quarter, 2 quarter, 3 quarter growth story, or whether the consumer has more oomph.
Some of the story has been around the domestic reforms that have taken place and the moving away from the zero COVID policy. But what about on some of the international relations that China needs to also continue to foster or maintain in order to see growth? What would you be watching for there?
Well, I think what 2023 is seen is a real goodwill tour by Xi Jinping and the Chinese towards the Europeans. One of the issues here has been to head off potential coordination on export controls, but also there's been a message: China's open, come back to China. A little bit of that in Asia too. So yes, of course, China is trying to become a magnet for more foreign investment, which has not been the case for the last several years. But, this is a very tricky time because of rising geopolitical tension. So, there's a message there, but I'm not sure people believe it yet.
Does that goodwill start to run out when you see some of the military exercises that China had even put into kind of a drill fashion in recent weeks.
Certainly, those are the rising geopolitical tensions. You've got problems with export controls and sanctions on advanced technology. Everyone is looking very closely at the way that China interacts with its neighbors and the way U.S.-China tensions are headed. You don't want to go too big into China if you think that you're going to have pressure to try to get out. So, we're seeing a lot of companies go into China. They're very focused on the Chinese market, but they want to produce in China for Chinese consumers. The supply chains that run through China and then back out exporting to the West, a lot of people are picking those up and pulling those out because they're worried about geopolitical tensions rising in the coming years.
And we did see some commodities, oil especially, rising ahead of the launch of that GDP data. In terms of the commodities that you're going to be watching here, when you look at the demand story for China, what stands out to you?
Well, we track steel, aluminum, copper, coal. We also look at proxies for oil and other things. Obviously, we're going to be looking at how property recovers and how commodities recover. Is there a bigger oomph into the fiscal stimulus? And is there a bigger push towards pushing growth through building, which has been something they've done in the past, but not for the last several years. So we're going to be watching those commodities. We're going to be looking at oil, too, simply because everyone is so interested in whether the China recovery story is sufficient to sort of knock oil into the range of 100 or higher. A retail recovery, that doesn't necessarily mean that oil is going to skyrocket in China. Manufacturing is not doing great. Property still troubled, even though recovering. So this is a question that's going to be a lot more easy to answer once you get into the second quarter.
Leland Miller, who is the China Beige Book CEO. Leland, thanks so much for the time and the insights.
Thank you.